How are you all doing? Just give me the next few minutes of your attention, because what you're about to hear could completely change the way you think about money for the rest of your life. Most people spend their entire lives working for money without ever learning how to make money work for them. They wake up early, spend years working stressful jobs, pay bills every month, and repeat the same cycle again and again, hoping that one day life will finally become easier. But for most people, that day never comes, because nobody ever teaches them the difference between earned income and passive income. The average paycheck in America is around $5,000 a month, and most people believe replacing that income after retirement requires millions of dollars invested somewhere in the stock market. They assume financial freedom is only for wealthy people, celebrities, or people who got lucky buying the right investment at the perfect time. But what if the real number is much smaller than people think? What if building passive income isn't about luck at all? What if it's simply about following the right strategy for a long enough period of time? In this video, I'm going to show you how someone can slowly build a monthly paycheck using Vanguard index funds without day trading, without rental properties, and without gambling on risky investments. This strategy is built around one simple idea: creating a portfolio that quietly grows in the background while paying you more income every single year. And the most important part is this portfolio isn't built around selling shares, because during market crashes, selling investments becomes dangerous. Instead, this strategy focuses on building dividend income that continues paying whether the market is up or down. I'll explain why most people completely misunderstand the S&P 500. When it comes to passive income, I'll show you the dividend mistake that traps beginners for years, and then I'll walk you through the Vanguard funds that can realistically help someone build $5,000 a month in passive income over time. Hello, my friends. How are you all doing? Just give me the next few minutes of your attention, because what you're about to hear could completely change the way you think about money for the rest of your life. Most people spend their entire lives working for money without ever learning how to make money work for them. They wake up early, spend years working stressful jobs, pay bills every month, and repeat the same cycle again and again, hoping that one day life will finally become easier. But for most people, that day never comes, because nobody ever teaches them the difference between earned income and passive income. The average paycheck in America is around $5,000 a month, and most people believe replacing that income after retirement requires millions of dollars invested somewhere in the stock market. They assume financial freedom is only for wealthy people, celebrities, or people who got lucky buying the right investment at the perfect time. But what if the real number is much smaller than people think? What if building passive income isn't about luck at all? What if it's simply about following the right strategy for a long enough period of time? In this video, I'm going to show you how someone can slowly build a monthly paycheck using Vanguard index funds without day trading, without rental properties, and without gambling on risky investments. This strategy is built around one simple idea: creating a portfolio that quietly grows in the background while paying you more income every single year. And the most important part is this portfolio isn't built around selling shares, because during market crashes, selling investments becomes dangerous. Instead, this strategy focuses on building dividend income that continues paying whether the market is up or down. I'll explain why most people completely misunderstand the S&P 500. When it comes to passive income, I'll show you the dividend mistake that traps beginners for years, and then I'll walk you through the Vanguard funds that can realistically help someone build $5,000 a month in passive income over time. But before we get into the numbers, there's one thing most people never realize about building wealth. Most people chase excitement instead of consistency. They think becoming rich means finding the next Tesla before everyone else, buying crypto before it explodes, or turning some random side hustle into millions overnight. And yes, sometimes those things work, but they also come with stress, uncertainty, and risk that most people never talk about. Real estate sounds amazing until something breaks at midnight and you're the one paying the bill. Picking individual stocks feels smart until one terrible earnings report destroys half your gains overnight. And crypto can make people rich, but it can also erase years of savings in just a few weeks. That's why index funds are different. They're boring on purpose. Instead of betting your future on one company, you own hundreds or even thousands of businesses all at once. The winners balance out the losers. The risk spreads across entire industries, and over long periods of time the market keeps moving forward because businesses continue growing and economies continue expanding. Index funds don't promise overnight wealth. They promise reliability, and reliability is what actually builds long-term financial freedom. But before building a portfolio like this, There's one huge mistake almost every beginner makes. The moment they hear the word dividends, they immediately start searching for the highest yield possible. They see investments paying 8%, 10%, or even 15%, and they think they found a shortcut to passive income. Bigger yield means bigger paycheck, right? Not exactly. Usually, giant yields are warning signs. The market is basically saying something is wrong with that company. Maybe profits are shrinking, maybe the business is struggling, or maybe the dividend itself is about to get cut completely. And when that happens, investors lose twice because the income disappears while the stock price crashes at the same time. That's why smart dividend investing isn't about chasing the highest yield. It's about balancing reliable income today, dividend growth tomorrow, and long-term appreciation in the background. Because a fund paying the percent today but increasing its dividend every year can eventually produce far more income than a stagnant investment paying 7%. The high-yield investment stays flat, while the growing investment compounds year after year, and over long periods of time. Compounding changes everything. So before choosing any investment for this portfolio, every fund has to pass 3 important tests. First, it needs a reliable dividend yield today, not too low but not dangerously high either. Second, it needs strong dividend growth because rising income is what eventually creates financial freedom. And third, it needs long-term appreciation because the portfolio itself should continue growing in value while the dividends increase alongside it. That combination is where the real power comes from. Now here's the question. Why not simply buy the S&P 500 and call it a day? After all, it's the most famous investment strategy in the world. Well, because the S&P 500 was built for growth, not income. And there's a massive difference between those two goals. The S&P 500 is incredible for building wealth over long periods of time. Historically, it has created millionaires for decades. But when it comes to generating income, the yield is extremely small. If someone wanted to generate $5,000 a month using only the dividends from a traditional S&P 500 index fund today, they would need millions of dollars invested already because the yield is tiny. The S&P 500 focuses primarily on growth companies, not income-producing companies, which means if your goal is building monthly cash flow instead of simply growing net worth, you need something designed differently. That's where this portfolio comes in. The first fund inside this portfolio is the Vanguard Dividend Appreciation Fund. This fund focuses on companies consistently increasing their dividends year after year. Businesses like Microsoft, Visa, Coca-Cola, and Johnson & Johnson. These companies aren't just paying investors, they're rewarding them with bigger payments every single year. The starting yield may not look exciting at first, but the long-term growth becomes extremely powerful over time. This fund acts like the engine of the portfolio because it focuses on quality businesses with stable earnings, strong balance sheets, and consistent dividend growth. The second fund is the Vanguard High Dividend Yield Fund. This fund focuses on companies already producing strong cash flow and healthy dividends. It adds stronger income into the portfolio immediately while still maintaining diversification and stability. The third fund is the Vanguard Total International Stock Index Fund. Most investors keep nearly all their money inside the United States because American companies have dominated global markets for years. But there are thousands of strong companies outside the U.S. paying reliable dividends that many investors completely ignore. This fund spreads investments across Europe, Asia, Canada, Australia, and emerging markets around the world. And because international markets have lagged behind America for years, many international companies now offer higher dividend yields than American stocks. The fourth fund is a Vanguard International High Dividend Yield Fund, which focuses specifically on international companies producing strong, reliable cash flow. And finally, the fifth fund is the Vanguard International Dividend Appreciation Fund. This fund focuses on international companies consistently increasing their dividends year after year instead of simply paying large yields today. Together, these 5 funds create a portfolio designed for both income and long-term growth instead of short-term excitement. Now let's talk about the actual numbers because this is where everything finally becomes real. Imagine someone starts with $10,000 invested into this portfolio and then consistently adds around $10 a day, roughly the cost of coffee, snacks, or fast food. Nothing extreme, nothing impossible, just consistency. At first, the growth feels painfully slow. The account moves, but not dramatically. That's the phase where most people quit because compounding is almost invisible in the beginning. Early investing feels unrewarding because the numbers still look small. But what most people fail to realize is the hardest part of investing isn't the math, it's patience. Around year 10, something starts changing. The reinvested dividends begin buying more shares. Those shares begin creating even more dividends. And eventually the portfolio starts growing faster than the actual money being added into it. That's when compounding finally takes over. And once it starts, the growth curve begins accelerating rapidly. By year 20, the portfolio starts moving much faster than most people expect. And by year 30, the account can realistically become large enough to generate around $5,000 a month in dividend income without selling shares. And that's the part most people never understand. The majority of the final wealth doesn't come from contributions. It comes from time. Time multiplying dividends, time multiplying growth, and time doing the heavy lifting, because compounding is like a snowball rolling downhill. At first it barely moves, but eventually it becomes impossible to stop. But maybe you don't want to wait 30 years. Maybe you want financial freedom sooner. Well, shortening the timeline changes the math dramatically because compounding needs either more time or more money. Someone trying to hit the same target in 20 years instead of 30 would need a much larger starting investment and significantly larger contributions along the way. That's the trade-off nobody escapes. Money or time? Usually both. And honestly, that's the hardest truth about financial freedom. There's no magic stock, no hidden shortcut, and no secret investment strategy that instantly makes ordinary people rich overnight. The real advantage is consistency mixed with patience. Most people quit before compounding becomes visible, but the people who stay invested long enough eventually reach a point where their portfolio starts working harder than they do. And once that happens, the entire game changes, because eventually your money starts paying for your lifestyle instead of your job. That's real financial freedom. Not waking up rich tomorrow morning, not buying luxury cars from crypto profits, not becoming famous online. Real financial freedom is waking up, knowing your investments continue paying you, whether you're working or not. And the reason this strategy works is because it removes emotion from investing. You're not constantly guessing which stock will explode next month. You're not panicking every time the market drops 10%. You're not gambling your future on hype. You're building a system designed to survive recessions, market crashes, inflation, fear, uncertainty, and time itself. That's the power of diversification. That's the power of consistency. And most importantly, that's the power of patience. Because time is the single greatest advantage ordinary investors have. The market rewards people willing to think long-term while everyone else chases short-term excitement. And here's something most people never realize until it's too late. The earlier you start, the easier everything becomes. Someone investing small amounts consistently in their 20s can end up with more wealth than someone investing huge amounts later in life. That's how powerful compounding truly is. Time matters more than perfection. Starting matters more than timing the market perfectly. And consistency matters more than chasing impossible returns. Now, does this mean investing is risk-free? Of course not. Markets will crash. Recessions will happen. Fear will spread. And there will absolutely be moments where it feels easier to quit than continue investing. But historically, the market has always recovered. Every crash eventually became another chapter in a much larger upward trend. The people who panic usually lose. The people who stay patient usually win. And that's why building wealth is less about intelligence and more about behavior. Most people already know what they should do. Spend less than they earn. Invest consistently. Stay patient. Avoid emotional decisions. But actually following those rules for decades is what separates financially free people from everyone else. So if you take one lesson away from this video, let it be this. Financial freedom isn't built in days, weeks, or months. It's built slowly, quietly, and consistently over years. And the people who understand that eventually reach a point where their investments create more freedom than their jobs ever could. That's the real goal here, not getting rich overnight, but building a system that keeps paying you forever while you focus on actually living your life.